Hello and welcome to Unit 2, Consistency and Comparability. In the previous unit, we looked at the key characteristics of useful KPIs, and we saw that one such characteristic was comparability. In this unit, we're going to drill down a bit further on this idea of comparability and also look at tools that can be used to increase the comparability of KPIs. So consistency and comparability is of utmost importance when it comes to KPIs. Why? Because the purpose of a KPI is to allow an investor, a stakeholder, or a manager compare the performance of a firm over time, or to compare the performance of the firm against a competitor or comparator. In order to be able to compare two things, they have to be in the same unit. So this is why consistency and comparability is of utmost importance. Another important thing to think about when measuring KPIs and reporting them is transparency. Transparency in where the data for the KPI was gathered. This is useful to increase the trust in the measure. Will also be useful if your reports need to be audited and you need assurance on them. So if the KPIs we use are consistent, comparable, and transparent, this will lead to an increase in trust in the information, increase in trust in the data, increase in trust in the performance of the company on the given metric, and also an increase in trust in the management. The importance of consistency and comparability in integrated reporting is evident in the fact that it forms one of their guiding principles. This principle states that the information in a report should be presented on a basis that is consistent over time, allowing the users of the information to compare previous performance with current performance, and also in a way that enables a comparison with other organizations to the extent it is material to the organization's own ability to create value over time. So you should be able to compare two organizations, not on every metric, but on the metrics that are important to the value creation process of each individual company. This means that reports don't need to have information on every single thing, only that which is important or material to a given company. It states that this is important for the information, this consistency and comparability is important for the information in an integrated report, and this also applies to the KPIs that are used to measure performance in said report. Now let's turn our attention to the tools that can be used to enhance the consistency and comparability of KPIs reported as part of integrated reporting. There are a number of methods that we can use, the first of which is to present information in the form of ratios. Ratios are where you combine two pieces of information or two pieces of data into a new KPI that offers additional insight into the performance of a company on a given dimension. An example of a ratio would be research expenditure as a percent of sales, which combines information on the research expenditure of our company with information regarding the company's sales and gives us insight into how much of the company's revenue they invest in R&D, so giving us an indication of how innovative the firm might be or how much it spends on innovation. Another measure is carbon intensity, which tells you how carbon efficient a company is or the amounts of emission they create per unit of output. So this gives us a measure of its efficiency rather than a measure of the absolute amount of carbon it creates. The second method is to use benchmarking data. So alongside reporting your KPI, you also want to report the previous performance on the KPI to give readers of your report an indication of how your performance has changed. In addition to this, you should provide information on what your targets were. Even if you didn't meet your targets, you should report how you did or how your performance compared to what you wanted to perform. Finally, you should also provide peer, industry, and regional benchmarks. So how do you perform against others in your industry that do a similar thing or have a similar business model? Finally, the third method to enhance consistency and comparability is to report using a common reporting framework. So this is using quantitative indicators commonly used by other organizations with similar activities. Particularly when standardized definitions are stipulated by an independent organization. So following someone else's and independent bodies reporting framework also enhances the comparability between your reports and the reports of others that use the same reporting framework. It can be seen from the graph here that the most commonly used reporting standard today is the Global Reporting Initiative, or the GRI. This initiative rests on the premise that corporate transparency on environmental, social, and governance issues would catalyze action by companies to improve their performance on these dimensions, and that as a result, the incentives for companies would be aligned with that of society. So it can be seen from their founding purpose that the focus of the GRI is to measure the impact of the company on its external environment or on society. So this is to measure impact materiality. This can be further seen in how they define what is a material topic. So the GRI states that material topics are those that represent the organization's most significant impacts on the economy, environment, and people, including impacts on their human rights. So it's the external impact of the companies. To measure and report using the GRI, there are 3 series of standards that a company must follow. There are the universal standards that set down the rules and regulations that the company must follow in order to report using this standard. Then there are the sector standards, which dictate which topics are material to certain sectors or to certain industries. And finally, there are the GRI topic standards, which give a list of what should be reported for a given topic once that topic has been identified as being material to the company. The process for reporting using the GRI standards is similar to many others and has 3 steps. The first step is to identify and assess the impacts of the company. This is done through gaining an understanding of the company's business model and its organizational context in order to identify actual and potential future impacts of the company. Once this is done, we must assess the significance of these impacts. The next step is to determine which topics are material by prioritizing the most significant impacts that the company will report on. Once we've identified the material topics, the next step is to report, to gather the relevant information, to report specific information that's dictated by the topic standards for the material topics of the business. As we draw to a close, I would like to thank you for your time and attention, and I will see you in the next unit.